Welcome to the July monthly update for Galileo Capital. It's one really interesting time, and I feel like I say that every time I do one of these, that the world's just not simplifying and kind of stabilizing. It seems to get more complex and more variable as we go. So I'm very happy that you're on with us, Pragnesh. Thanks so much for joining.
How's it, Warren? Yeah, well, interesting times indeed. Never a dull day in 2025.
So when we were discussing the topic, you said in your usual very long-winded way, war and peace, and I think it's a great one for today. So we are in a time where there is a lot going on, sort of geopolitical tension, and I think it does attract a lot of news. Maybe what's interesting for me, having lived through quite a few of these wars right around the world in markets and watching how markets react, is it seems to me that when bombs get dropped, you would expect markets to go down, and that's not always the case anymore. We see a situation where the Americans drop a bomb, quite a few. It seems like the biggest bombs since the nuclear bombs. On Iran, and Iran responds, and as Iran responds, the stock market strengthens, the oil price goes down. What on earth is going on?
Yeah, well, indeed, right. So one would expect, dramatic reactions. You do see reactions, but in micro pockets of markets, that are probably in the immediate vicinity of the trouble spots. But generally, staying back and thinking back, and you look at what's going on, and you'll see that in the Western Hemisphere, so that means if you had North America, US and Canada, and then Western Europe, at one level, they're immune from these geopolitical tensions, which are, quite to the Northeastern Hemisphere, if I was to place Johannesburg at the center of the world.
Which it is, as we all know.
That's right, yeah. So, and because of that, and because of the fact that Western countries continue to enjoy economic superiority, I think the effect on markets is much less pronounced. So certainly markets don't take too much risk off into account. It looks like in some of these limited geopolitical pockets, right? But you can't say the same thing about oil as an example. So oil, we have seen, oil and gold have been such an excellent study in, contrast and vis-a-vis other markets or other asset classes, and those have been the most reactionary, for lack of a better word.
So I mean, if I look at it, as you say, I mean, one of the important things to do in a situation like this is to zoom back, zoom out, and overlay a bit of history over all of this, because it's easy to get caught in the hype and the detail of what's going on now. And I mean, I think always, I mean, I know it sounds obvious, but always when we're looking at this, our job as investors is to be dispassionate, to have a long-term view, and to try and make the most sensible, rational decisions we can. That doesn't diminish from the massive human impact of what's going on. So I mean, I think it's just worth saying that, like, we don't dismiss what's going on in the Middle East and in Ukraine. I mean, those are human tragedies on a grand scale. But it's our job to look around and say, how do we make sensible, rational, long-term investment decisions that, number one, protect capital in bad times, and number two, generate capital growth in the best way we can, taking the least amount of risk per percentage of growth. And what's interesting for me is, I think when you kind of zoom out a little bit, we've got that mega trend, which is interest rates were very high, inflation was very high, both in the US and in Europe. And that's an important backdrop to what's going on. When you look at the state of the world now, interest rates in the US are still very high. Inflation is the question, what's going to happen there? But there is scope in the US, if things go well, for interest rates to come down. And I think that's a kind of a backdrop to what investors look at when they look at the US market specifically. equally in Europe, interest rates have come down. And I think that it's Europe has been surprising both in the way that their governments, especially Germany, are willing to invest and stimulate that economy and to spend on defense and spend on other kind of infrastructure parts. And I think for me, when I look at this, that's a big kind of backdrop to where we are. We are in conflict. We don't want major pipelines to be disrupted for oil or major logistics avenues where shipping gets disrupted. We don't want those things to happen. But at the same time, the moment investors feel some sort of certainty that actually that's not going to happen, the conflicts that are going on are quite isolated away from the things that are strategic to, I think it's important to say it's strategic to China and to Russia. That's what's important to Iran. They don't care that much about you, me, and America. They're worrying about their allies. So they're obviously signaling to the world and to their big allies that they're going to do things to kind of get retribution away from logistics. And I think that potentially that's what investors are looking at and saying, okay, this is conflict, and it could have escalated much more broadly, and it looks like it's been refined. At the time of recording, Donald Trump is on social media telling the world that there's a ceasefire, and I'm not quite sure of the timing of that, if it was just before the next wave of rockets arrived in Israel or just after, and what will happen, we don't know. But equally, maybe that we're getting a sense that this is going to be an Iran-Israel issue more so than the broader Middle East. So if that's the case, it allows investors to cut, and including ourselves, to zoom out again and say, okay, that's another element of uncertainty, but maybe the bigger uncertainty for now is still tariffs, trade restrictions, et cetera, between the US and, well, actually everybody else.
Yeah. So if you look at, so I was just reviewing the 6 months, right? So we kind of end of June, yeah? If you stand back and look at the 6 months, the biggest drop was around in the first week of April, and quite a sharp drop because of the US-China tariff drama, where the tariff was hiked quite high and obviously unreasonable. But it was also not the time to exit necessarily, right? Because just 10 days later, and you were up 12% compared to the low of that day, right? So, and that's not been matched since, notwithstanding an Israel-Iran conflict where we have not seen such a drop, right? So, and I also do think that because America itself is quite self-sufficient in oil, right? The effect is not as pronounced of localized Middle East. It affects Asia more. And because of that, Iran's own allies will pressure it to not poke the bear, so to speak, right? So, too much. So I think that's interesting. So like you say, it's tariffs and trade wars and those kind of dynamics that are more driving the markets than necessarily, sadly, for human life, but, proper physical kinetic conflict. And what's very interesting is, South Africa itself, right? At one level, it also feels, you're kind of cut off from the geopolitical dangers of all of that. You're not cut off from the markets, but what's interesting is that the South Africa story is still intact, despite all of this trouble.
Yeah. And potentially that, if a few things go right, that South African story picks up momentum. I think it's incumbent on us just to talk a little bit about some good news, which I don't think has got much airtime around the last plenary session, say that after a few drinks, but the plenary session of FATCA, which is really the global body that decides on who are the good countries, who are in the middle of the range, and who are the naughty countries. And for a quick refresh, we were taken from the good list, put on the middle, the watch list, and that's called the grey list. And the potential for us was to either go down, so be down rated at some point onto the naughty list, which would have been fairly catastrophic in my view, or to take corrective action and get ourselves back on the good list. And at the time of recording, what we now know is that plenary session, which happens in Paris, has said that on the surface, so according to paperwork as opposed to site visits, South Africa has taken meaningful action on all 22 of the steps that they had identified that we were deficient. And so there is scope for us to be upgraded, but that's subject to a site visit. I don't know who does that, and if they go to Londolozi or if they go to Joburg. I hope they're going to send them to Londolozi. But I'm assuming that that they would be fairly positively inclined to find good reasons now to see the kind of paperwork and then say, right, you haven't lied about what you've said to us, the report back, and if that goes well, we're back off the grey list onto the good list. And I feel, I mean, you know more about this with your history in the banking system, but I feel the momentum is behind us now. Where we had negative momentum, where we had headwinds, it's now we are clearly showing action to correct what was wrong. And if we haven't ticked all the boxes perfectly, we're showing clear intent to move forward.
Yeah, yes, absolutely. And I hope it's some warm place. Nobody from Europe would want to go to a cold place to make this assessment. Having said that, we should also thank our clients, because I know that some of them might have been peppered with requests or give us this, give us that for FICA, KYC. And I myself have also been subjected to that. And, at the end of the day, it's important that we be in the good books, so to speak, of this kind of regulations, which can then only always be a positive both for the country as a whole, its finances, and more importantly, your investment portfolios and access to capital.
Yeah, and I think that's maybe that last sentence is the key point here. Is it's not going off the grey list onto the good list doesn't necessarily mean that suddenly we get more investor capital, but what it does do is it takes a concern away from investors who are looking globally and saying, where can we allocate money? And if you're on a grey list, it's another headwind that investors would just say, why don't we allocate money to countries that aren't on the grey list? So being on the right side of that equation is good. It's not the same, for example, as where you get a credit rating upgrade, because a credit rating upgrade would be immediately positive. It means that more investors would have more scope to allocate money to us if they want to. But I do think it's a headwind we just didn't need when it happened, and now that it removes, globally, it's very good for us. At a real kind of one-on-one level, it just means, where we've had stupid things like, trying to do euro transfers from rands to euros to an account, that's been very difficult. And that's been a direct result of the grey listing. And so, going off that grey list, I'm not sure that the whole banking system works instantaneously, that will immediately go through all of those channels and find life easier again, but certainly that it will happen quite quickly, and life gets easier, transactions get cheaper again, due diligences get it's hard to say reasonable, because I think we're right at the end of very unreasonable just in general, but they will become a little bit more reasonable than what they've been now. And maybe that, again, it's another piece of positive momentum. If we have spoken about the budget in previous recordings, but just if we show some fiscal discipline, I'm not brave enough to call additional economic growth, but if we show some fiscal discipline and we get off this list, it's just another step in a good direction for the country from a very, very low base.
Yeah, no, so absolutely. So we must just remember that in South Africa's case, our financial infrastructure is quite good. So the turnaround time of positive news flow should be much better than other countries that are on the grey list as such. So, we must always keep that in mind. We have a first world banking system and financial regulation and supporting infrastructure.
So just looking, maybe at a little bit more micro detail. So across our business, we always on a global basis have a lot of diversification in the portfolios that we manage, which means that if you do diversification well, you're hoping that 70 or 80% of the assets that you own are growing, and 20 or 30% might be stagnant or going down. And if you see that in a portfolio, that tells you that you've got very good diversification. And what's been interesting for me is that we've had quite a lot of growth assets in the portfolios doing well for quite a sustained period of time, whether it's been in the world index or growth shares. But what we haven't seen doing very well are the fund managers and investment products, whether they're unit trusts or exchange traded funds or investment trusts that are more value focused. And it's interesting now to see that those are starting to deliver incrementally more growth over time. So they might have been sort of lagging in the portfolios or just stagnant, and now we see that they're building some momentum. And I know you like to tease me about gold, but for example, a lot of those businesses own gold, and with the gold price having done well, that's been a positive to their performance. I do also think that high interest rates have been bad for all equity classes, all types of shares. But the prospect of value shares benefiting as interest rates come down, I think is also there. Potentially more so than other companies, because those value companies might be sitting with very strong balance sheets and actually able to deploy cash if they want to, whereas some of the growth companies might not have been in a position like that. So it's interesting to see that trend, Pragnesh.
Yeah. So absolutely. When we say growth companies, we found it was US centric, right? All of a sudden this year you're seeing a bit more democratization of that. Certainly Europe, you look at China, a bit of Japan, here and there. And we mustn't forget that, even if you take defense as an example, because I know some clients ask about, European defense have to spend more. And we must always remember that a very good offshoot of defense innovation is general innovation, right? Because it spills over. So if you go back to the internet was, in a sense, discovered or, by the US military, but just look at how it spread to other areas of our life and created new global champions, right? So similarly, defense innovation leads to other broader innovation generally. So, we also diversifying sources of innovation at one level. High interest rates also give a chance to companies with good balance sheet, typically what we call value shares as well, to kind of look at dividends as well. That comes into play, because in growth share times, no one cares about dividends, right? All of a sudden that also comes into play. So we must always have all of these kind of exposures in a portfolio generally.
Yeah, and I think that a little bit of a sigh of relief to say, that diversification, when you're holding assets that are not delivering for a period of time, it can become more and more uncomfortable, and we kind of look at each other on the table and ask ourselves, are we doing this correctly? And so it is very nice when that theme starts to unfold in the right direction. It does mean that there will be other sectors that might not benefit. When value starts to perform, you might find other aspects, whether it is very specifically US companies or tech or whatever the deal is. We don't know. We're not in the forecasting business, but there will be some that won't follow this trend. I think it is interesting to see how the world is, from a focus point of view. Even Americans are starting to look kind of outside of their shores to say, where else do we find growth? Where else do we protect against overvaluation on one side, or the impact of tariffs? Or, it's very nice to hear ratings agencies and reserve banks talking about instability, uncertainty, they don't say it in those words, but potentially crazy policy, and they're not talking about us at all. They're talking about America, and so that's very nice. The world is definitely shifting, and focus is broadening. And if conflicts stabilize, if interest rates do come down, it does generally bode very well for more emerging market exposure. Emerging market currencies tend to do better in those times as well. Again, it's not a forecast. We don't know, but we could see a situation where there is some decent stock market growth, not just in the US, but actually away from the US.
Yeah, and we're seeing that. So first half of this year, investors will see that other markets have done well, as have currencies. And I know people focus on the rand dollar a lot, they would have seen that there as well.
So Pragnesh, it's unusual that we sound upbeat in a time of tremendous uncertainty, and I think I certainly don't want to create the impression that we think everything is fine and that the world is in a great state and everything will be good next week and next month and next year. The truth is we don't know, but the context for today really is just to say, even when the news is noisy and there is human tragedy going on, it doesn't necessarily always translate automatically to poor stock market or investment market performance. Even with that news, there might well be times when markets deliver very good growth.
Yeah, and they do, and because we're not in the forecasting game, you can't even forecast when it turns around, right? And you get a up melt, and like the example I gave earlier around just the JSC in the over 10 days in April had the best return for this year, right? So you just don't know. And therefore, that's why we say remain invested, because the one thing you just cannot forecast is when you get the up melt.
Yeah, and maybe then just as a last point, our clients will note that we are our one adjustment that we are making to our investment strategies across the board is we are trying to increase diversification. So we've always been very diversified across asset classes, across geographies, if possible, across currencies. And what we're now doing as well is increasing diversification across types of managers. So, for example, where we choose one value-orientated manager, we might now have two. That's not a policy across every single client automatically, but just our adjustments to this state of the world as it is now is we feel we think we're well diversified from an asset class point of view across equities, bonds, cash, property, but potentially that we need to have more kinds of managers, running our assets for us, so that if one of them does make a major misstep, it's a relatively small impact on a client's portfolio. And so if you're speaking to us in the weeks and months ahead, and we bring that up as a theme, that's why. But I do want to emphasize that that's not the same as the diversifying away from index investing, for example. So if you own one index investment and it's the world index, and that represents 50% of your portfolio, that's not going to change because we believe that the world index is already massively diversified. And what we do with other investments around that is then increase the asset class diversification and potentially take advantage of some additional opportunities. But I do think it's a change for us. It's not something that we do very often, but it is. The world is materially different than what it was 12 months ago.
Absolutely, and again, risk management is key, and some of this supports that. And again, with a long-term focus, and there is innovation in this world, and where we see something decent that we can then take advantage of in our portfolios, we will do that.
Yeah, if we can, we'll drive costs down, increase diversification, and make sure at all times that if we're moving, if we're changing or switching or transacting, we're doing it as little as possible, and always for that reason that we're finding something better, more diversified, lower cost, etc. I think on that note, Pragnesh, it's one of our longer recordings. So just to say to everybody, thank you very much for your support. Thank you very much for your patience when markets are going crazy and we tell you not to make a change. There is a very good reason for it. There's lots of research going on behind the scenes. As you can see, both Pragnesh and I have got our grey hairs, so we're worrying on your behalf, but you don't need to do that. We'll take care of these things as they go.
Absolutely, and thank you everyone for your support. And Warren, very interesting discussion. It's continuous, interesting times.